Welcome to Dave and Dharmesh Demystify, a FinTech Futures podcast, helping make sense of the world of FinTech and digital finance. Please sit back and listen as the two Ds take a subject and discuss it to make it clearer and easier to understand.
Demystify.
Welcome everybody to the Dave and Dharmesh Demystify show, and this week we're going to do some more demystification of core banking, but from a real expert, not me. That expert is Gareth Richardson. Welcome, Gareth. Great to see you, mate.
Great to see you too. Well, that introduction, I've now got something to live up to, haven't I?
Yeah, I thought you meant me, and I was going to say no.
For those that don't know you, Gareth, do you want to give us a bit of background and then maybe introduce what you're doing now?
So, background, engineer by background, but really been in financial services for sort of 20 odd years, but do a load of consulting work before that in multiple different industries. But it was 6.5 years before the last 7 months I've been at Thought Machine as the COO and sort of deputy CEO, looking at strategy, how we grow Thought Machine, what we did with it, how we went to attack the market, looking predominantly about, I looked after the customers, how we helped them with their transformations, how we made them hopefully go live. And we did get 40 odd banks live. And in the end, did 75 banks around in 26 countries with some significant migrations of millions of customers. Now in position as CEO at a UK FinTech called Finova. We actually process with 63 financial institutions in the UK, process nearly 20% of all the UK's mortgages come through our platform. We have around 50 billion on our core banking platform in assets every day. And we go everywhere from brokers, and we have a broker CRM with 2,500 brokers, all the way through to lending and savings being calculated every day with interest on our core banking system. So pretty significant, and do around, as well as that, we do about 80% of equity release in the UK, so for insurers and that sort of thing. So penetration in the UK market are now obviously looking to adopt AI and bring all those things into there, and we can have those conversations later on, but that's where we are now.
The thing that kind of strikes me is a couple of things. One is that, and apologies, one I should know, but I never really heard of Finova. So I'd be interested in like what its background is, how long they've been around, etc. But also, I didn't think there were 63 financial services companies running core in the UK. but it's going to shed some light on Finova and the kind of customers they've got.
Yeah, so in equity release, it's really insurers, so LV, Aviva, those guys. And then as you move out in Key Group and the big funders, so Rothschild, etc., who fund a lot of the equity release market, which is, as you know, is probably a growth area for this market, quite frankly. As we all get a bit older, we all want to have credit for longer and access that in more interesting ways. And I think it's been a bit of a dirty word for some reason for a while, and that really shouldn't be the case, but that's the way it is. And the business it's been acquired as an acquisition of a few businesses that have come together. So that's really why you don't sort of know about it necessarily. But the heritage, some parts of the business goes back a couple of decades. But it's, of the 63, there's different flavors of what we do for different people. So it's not all doing core banking, but we do 6 of the top 8 building societies, where we process loan origination and savings origination, different varying flavors of. But we cover lending, mostly real estate lending in the origination side, but that covers everything from standard residential mortgages through to specialist lending, as I said, all the way out to equity release, but all the flavors thereof and all of the sort of processing requirements and the decision engines and those sorts of things to make sure that we do, people have rights to lend and that sort of stuff all around that market. So a chunk of the business came out of IRES, which was spun out from MSO. There was a company called BEP that built more like tier 3, tier 4 lending origination platforms, and then another platform that delivered all the core banking pieces, and they've sort of come together, and that's what Finova now is. It's owned by Bain Capital, so it's private equity backed, and that's what we're now on the sort of structuring that and taking that forward.
Interesting, because I was looking at the website and saw how kind of there was quite a focus around building societies. And I think building societies are often forgotten about in the world of FinTech. And I guess there's a number of reasons for that. One is perhaps the view that they're a bit kind of sluggish in terms of adoption of technology. So, but it is good to see, because I think building societies are an incredibly important part of the UK financial setup. So based on the experience you have, what's your view on the sector itself and how quickly it's looking to digitize? And I mean, I was doing some work in the sector sort of a few years ago, and it was difficult enough to get them to think about kind of the basics of a mobile app, let alone now having to think about AI.
Well, we consider ourselves sort of their tech vendor, if you like, because, or their technology department, if you want to think of it in that way. And it's really down to us to bring those services to them that they can then adopt and take forward for their members. In some areas, very forward thinking. In some areas, take the time because they've got branches, they've got all the sort of the ecosystem and the care for their customers, probably more so than some of the banks. And we also obviously have bank customers. But we see ourselves as their technology department. It's our job to make sure that we deliver those features and deliver that update, and we provide the mobile app for them, for example. And now it's a case of us making sure that we keep that up to date and we keep rolling that through so that they don't have to invest in that stuff and they keep doing what they're good at and we keep doing what we're good at. If you can support someone and build that ecosystem around it, and take the responsibility pretty seriously that you're pretty systemic to the UK market. How do you look after that? How do you make that better? How do you evolve that towards AI in a way that enables them to adopt the technologies and tooling without them having to do the lifting and all that sort of stuff themselves? I think if we go back to the sort of thought machine piece, we focused on the largest banks and the largest institutions. But when you got to the smaller institutions, especially in the States and other places where you're dealing with very small institutions that look after their local community, quite frankly, that putting in a mobile app, like you said, Dave, is like in some cases transformational. I mean, I remember a conversation a couple of years back where a guy was trying to buy Thought Machine, but he just put his first ATM in. And I don't think you're ready for us. Let me be clear. But that, where we want to be now at Finova is building the plumbing all across the top of these pieces such that we can provide that as their service for all of them to deliver that great. We all know the transformational nature of a lot of these technologies for the customers that they have there. We just need to find the right way of packaging it up and delivering it to them so that they can take it and adopt it. But they are adopting. We have lots of people. The whole reason why we've done quite so well in the last few years is really taking them on a journey into cloud and then taking them up into mobile apps, standard user interfaces, and then linking in through APIs and other stuff into the sort of more composable world. I wouldn't go as far as that, but they're moving into sort of composable banking in some respects. And we're starting to pull that together for them as an ecosystem provider.
Do you think that a core vendor can actually service both ends of the market? I mean, like what the tier ones want versus what a tier 4, 5 might want?
Frankly, no.
I'm glad you said that because I totally agree. It's something that we tried at Temenos, and I argued that actually the larger tiers, the tier ones, wanted very specialized things, not a complete package. And the smaller banks just wanted an out-the-box, as complete as possible solution. But I mean, what's your view?
Agreed. We were at Thought Machine, we were very clear about what we were going after and what we were building it for. And even then, when you build the first product and you build this engine that will run everything, the complexity that you've got to deal with when you first walk into 2 or 3 tier ones, it's not the front book, right? The front book isn't the complex bit. It's the back book that they've got from 60 odd years of different innovation that is still running in that mainframe. And you've got to dig your way through it and have an engine that is flexible enough, that will scale enough, that will do these things for them. They've already invested in channel. They already have completely unique needs in that sense. Whereas you go to the back of the further end, and quite frankly, you'll find 2 people in technology and nobody else who have a vision, who have a dream of what they want to. It's not like they're not forward thinking or anything else, but they don't have the skills or the resources or anything else to deliver that stuff. And I think that's been the problem of composable banking. We all sat around and went, yeah, they're great. We can compose the greatest bank in the world and let's give APIs. And I built a bank with 43 partners in Asia at one point, which it cost hundreds of millions because everyone's taking a profit cut all the way through. Yes, it's bloody brilliant. But you ask anybody in community banking anywhere around the world to go and implement that. No chance. It doesn't work. You've got to bring a lot more to the table. And by doing that, you're obviously not going to be, you can be best of best in certain places, but in other places, you may work with partners and other things. But at the end of the day, you have to be the single unifying factor across the top of that and bring together the right capability. That's what we Thought Machine. We started building an app integration layer and an ability to pull together 43 other partners in a neat ecosystem, because what we realized, we were turning up and going, here, 43, you go and build all those yourself. That's not going to work either. But what we ended up doing was building the integration framework, the security framework, and all the other stuff, which helps somewhat, but still doesn't get all the way. You need to bring the UI, you need to bring the mobile app, you need to build the interactions with people and give all that stuff so they can configure it. They still want to look unique, but what's unique in this market? I mean, a savings account is a savings account at the end of the day. Unique is how you talk to customers and almost like the service that you put around it. And it's how do you get that service, that tone, that everything else for that customer.
I mean, it is interesting because it's been a long time, and maybe I just haven't been looking, but it's been a long time since I've seen kind of a turnkey solution in the way that you're selling one. And yet you're right. I mean, for many kind of small institutions, having a turnkey solution is like ideal, isn't it? Because they don't need to worry about kind of differentiation, because so much of what they're built on is that community and the locale, isn't it?
Yeah. And the old hackney phrase of private wealth is just retail with a thicker glove. For the other guys, it's probably retail with local picks and shovels or whatever else you want to do when you want to go to agriculture or you want to go to this seed lending. You need to just target those things and have the right message, but it's the similar product.
I'm fascinated by this whole focus on equity release as well, because as you say, it's not got the best kind of PR in general, but it doesn't take a crystal ball to sort of see that has to be a solution for many, many homeowners who have high value in their properties, but sort of low amounts of cash. So do you sort of see that market just getting bigger and bigger over the next decade?
Yes, fundamentally. And I think the distribution of products changing as well, rather than just being a straight equity unlock, equity release product. There's short-term home releases of loans into that, and then how you pay it down. There may be short-term mortgages that bridge for a period of time. There's a bunch of different ways of looking at it. I think if we think about later life, it probably starts at like 55. People are thinking later life lending starts at 75 when they want to release some cash out of the thing to keep going. But actually, I think if you treat everyone based on what you've got, your pension assets, how do you take those into account when you're looking at whether you're lending to people or not? You've probably got a decent pot by that point. What does that mean? How does that work? Doing those sorts of things, I think that all expands. And if you talk the equity release team, customers that we've got, they just see that they're limited both by opportunity and really the number of brokers that don't necessarily understand it, or it's easier for them to sell a straight 10-year residential mortgage rather than thinking about what people really want holistically and selling the sort of later life pieces. The funding's there, the regulatory position has got much clearer. And actually they're quite, because of the amount of information they have to take in to decide to lend, help, all the other stuff. It's a really sophisticated lending process now with really clear lending criteria, how it's being done. Our decision engines that run on that are much more complicated than any of the decision engines that run in any other lending that we have. So I think it's a much more sophisticated market, quite frankly. And if we can open that up a bit more, it's got a much better chance of serving many more of us for a lot longer and offering those pieces. The clear part of the market that will grow just with demographics.
I'm suddenly thinking about it, that we do get quite a few people from places outside the UK listening to the podcast. Could you just sort of explain what equity release is?
Yeah, very simply, you have a home, you've probably paid it off. You are in the later ends of your life, but you want to get some capital out of that. Might be that from healthcare, be that for just living your life a bit more. You'll have a set of income from your pension, but you don't want to take a lump sum yet, or you don't want to draw down on it because it's not tax efficient. Then you can look to take some of the equity out of your home, and a lender will give you that equity against your property as an asset, basically. and unlock that money for you to do as you please within reason as you go towards later life. So if you've got some health concerns or some other things, or you've got family members you need to help out to get onto the ladder or whatever else, it's a way of releasing that without you moving house, without having to sell and get all the tax issues that may come with that, and just manage those and release that equity to do something with. There's lots of different options that would go around that, and you can imagine the different pieces people have to take into account of how long you're going to live and when will you pay it back and all those other things. So there's more sophistication in it, but traditionally it was seen as a sort of a slightly grubby way of conning the typical old granny out of money and out of somebody else's inheritance by getting them to unlock money to go on holiday, and then the grandkids don't get the money. But the reality is that as we all live longer, as we all want different life expectations and healthcare gets so much more expensive, there are lots of ways that people would use that to manage their own financial circumstances and move that forward. So it's a positive thing.
I totally buy. I mean, I guess one of the things that may be interesting is people slightly young. I mean, you talk about 55. I think at that stage, people are starting to think about their futures and when they want to retire. And, I think a lot of people want a bit more freedom to do the things that they want while they're still healthy. So that seems to be a kind of emergent trend. And I'm guessing that things like equity release are a way of them kind of tapping into the value of their properties.
I mean, what's the phrase? Your 50s may be better than your 40s, your 60s may be better than your 50s, but your 70s probably won't be better than your 60s. So there is a timeline when you want to take that and get the benefit from it. And that's an opportunity.
Again, I'm interested in, because there's a lot of complexity around people's emotions around these sorts of decisions. My suspicion is sort of dealing with a building society I don't know, there's a friendlier side to a building society because they generally know you, they know the area. Are they better placed to have some of these conversations than, a large faceless retail operation, do you think?
Yeah, I mean, the funding usually comes from the insurance side today rather than coming from a normal sort of savings-led credit piece. But it's definitely somewhere where we see that expanding. And yes, absolutely. The mutuals have the right understanding of you. They need some sophistication, which we help with, to be able to price those things and manage it. And they need the funding lines to come through. But that is all in place. And there's plenty of steps in this area, but we are the market leader. So it's like, look, let's help you think about those things as we move forward.
You're right. This has been around a long time. I've looked at it for some family members in the past and just found, to be frank, the products are very expensive, right? And there are probably better ways to crack a nut in some cases. But what's holding back the innovation? What's holding back progress in something much more compelling for people? Because I think there's a lot of people sitting on a lot of equity, sitting there doing nothing. And under Rachel Reeves, thank you very much, Rachel, more and more people are going to be suffering from fairly large IHT bills, right? I just feel like there's room for there's like an opportunity here for doing something rather special that maybe the incumbents couldn't react to.
There's a couple of people who are looking at this space really hard, and there's a few that we're working with or hope to work with as well that we're talking to about this. I think all the products are there. It's about, as you said, funding models, cost of it, and almost painting a roadmap. Dependent on where you are through that 50s, 60s, 70s plus, there are different products you should choose at that point. And whereas today there's like the equity release product, fundamentally later life lending should be a progression of different products for different things to help you out at the right point. Equity release can get quite expensive when you are very late in life and you're looking like you haven't got how long are you going to live and how much assets have you got left and all that sort of stuff. There's just a credit problem there in that sense that causes that issue. But that's not the case further down the line. And I think, as you say, all of us are sat on opportunities and we need education for the end customers. Brokers do a good job, but there's always more that can be done. We also need, and it's being recognized by a few of our customers today, but they need to start looking in that market. We also know that margin compression is a thing at the moment in a big way. And this is a natural place you can go to towards, along with other specialist lending lines where there's better margins to be made. And quite frankly, that will drive the innovation. People will go into that market because they're not seeing it necessarily in the straight residential.
I mean, I'm impressed with Dharmesh because he said all of that without mentioning the word fractionalization in crypto. So if you took those two words, would you be well placed to kind of be thinking about technology around this stuff? Or is that just an area which you think, well, let's leave it to other people to kind of deal with?
I think there's two parts to it. There's the asset securitization and what you do with those things going forward. And that's something we need to spend more time on, quite frankly. But that is something that is almost, how do you take that asset? There's a way of making the process better through that, through conveyancing and other stuff, and being able to run smart contracts, etc., to get those asset moving. But the bigger problem is sorting out conveyancing and other stuff if you want speed and process in that area. There's a lot of people who are pushing one-day mortgages. That's from an origination perspective. And my honest answer is I want the most efficient process to deliver a mortgage. I don't need a one-day mortgage. I need a mortgage that just goes straight through without needing a load of costs in and gives me the best deal I can get. I mean, the fact I'm going to have to wait 3 months for conveyancing and all the other stuff to happen makes my one-day mortgage somewhat immaterial. It matters because customers want to have an answer so they can go out and try and find their house. I mean, I get that entirely. But the difference between a one-day mortgage and a half-day mortgage or a 30-second mortgage is pretty immaterial. We do some of our app to offers is 11 seconds at the fastest case. I don't think anyone stood up and applauded us for that, because the process then takes another 3 months. So securitization can definitely help with that. And Lloyds are taking a real drive in that area and being the big beast in the market. That will really push a lot of things to happen from Charlie on down to make that change. But it's an ecosystem problem. It's, you've got PEXA and some others that are trying to work in that area to try and fix the conveyancing challenges. But they've got a lot of local authorities to get together. They've got a lot of pricing pieces to pull together. It's not going to be straightforward. But then if you look further on, then you get into crypto and securitization and what you do with that. At that point, it's an asset. As long as you can price it, as long as you can work it out, and you can take it into your decision engine, you can lend against it. And then the bigger bit for me in terms of making this work and reducing cost is really looking at that, using data and driving AI on top of that, and making smarter decisions and more complicated decisions based on the data to give people more access to these things at a cheaper cost, rather than necessarily getting into crypto and securitization as a mega trend, right? I mean, it's still going to appear, it's still going to be used, but as a mega trend, I don't really see it.
I wanted to ask you that actually, is that I did a bit of stint in the prop tech sector, and I did see some very interesting stuff around property valuations. And it struck me that banks were still fairly behind. I mean, there was a few exceptions, people like Kensington, and maybe one or two others that I came across that were fairly exceptional at valuing properties. But it seemed that the normal bank process was still in the dark ages for doing that. And obviously, when you're trying to use equity from a homeowner's perspective, you want the maximum possible valuation, right? I mean, I was just interested, are you doing anything interesting in that space? And especially with things like AI?
Yeah, so AVM, automated valuations, there's a bunch of providers, but you're right, they're not always used. They're generally, Home Track is in 18 in the top 20 in the UK.
Very traditional calculation. So that was the one that struck me the most, was that we were, with one of the companies I actually invested in, they were able to prove on historic kind of data that their valuations were like over 8% more accurate than Home Track. Yet, banks weren't taking on board the product, right?
But my point would be they're in 18 of the top 20, but they're not necessarily used in every part of the journey. So even then, even with the 8%, there's some banks that don't use it for remortgage, for example, because it's not in their flow yet. They use it for the major flows that come through the front door, but don't use it in pre-mortgage. Now, I'm not saying, but what's happening is the economics is forcing them to start looking at how do we actually drive this in a different way. And we're getting, AVMs are going in everywhere. And quite a lot of banks they're stopping to ask, they're not asking you for your salary, copies of your salary for 3 months, etc., because they can get that from open data sources. So there is a change happening. It's slow, but it is happening in that area. In terms of AI, I see it everywhere in the process as being able to do something really bloody great with the technology that's already here. We don't need to wait for more. So this comes back to me being their technology arm. If you go through the lending process, and sorry, I'll get a little bit stage gatey, but if you just from a lender perspective, there's loads of stuff you can do on the broker side as well, but just from the lender perspective, the brokers spend around 20 minutes researching each lender to work out whether they will lend to them or not. Guess what? We have policy documents that go over hundreds of pages that say what you'll lend or not. You can put that in a chatbot that can go through and tell you, will I lend against it or not? It's relatively simple, but that's probably in most lenders 3 to 4 FTE that can be freed up straight away just in that one piece there. You then once a package comes through, lending comes through, everything gets packaged up into all of the documents that you need. And there's probably 8 to 10 FTE in every lender packaging up these documents to check, are they true? Are they verified? Are they right? Now, you can scan all of those. We can already work out whether that somebody's giving me proof of address as a photograph of the door or their actual proof of address. You can do all those things automatically. So that's 8 to 10 FTE that could be freed up to get onto the BDRs and start selling more to brokers and driving more revenue. Underwriting is a massive place, quite frankly. And that's about most people in the industry, it's around 1.5 to 6 cases a day that underwriters process. And they should be up in the 40s or 50s for general residential underwriting. So you can just go through the whole lot and the technology's there. You just need the data, and we need to pull that together across the whole of the industry and then offer it up as standards to how to do this.
I mean, is it interesting? Because I guess what you're talking about there, I mean, it makes perfect sense, but it sort of moves you, going back to this whole thing of turnkey, into being more and more of as well as technology of service as well, isn't it?
Yeah, I think the banks will always do the service and they'll always wrap some pieces around it, but we need to be the underlying infrastructure as well as the turnkey. So you need to bring that infrastructure for a market and enable those people to be able to do that. And that's part of the turnkey, right? I mean, you can't be a turnkey if you're not going to help them run the most efficient part of their operation. Else you're a bigger cost than they are today. So we have to look at both sides of it. I see us as a data infrastructure provider long-term with distribution and an end-to-end provider of service to the end customers.
In your space, Gareth, how important is the actual tech? As in you versus, let's say, a vendor that's a monolithic mobile-based solution. Like, does the tech really differentiate in the space that you're in? Because we're led to believe that the likes of Monzo and Starling will destroy the traditional banks just because they've got a lower cost-income ratio. And that's not happened yet. So
I'm probably guilty of prognosticating the similar sort of things at times. So I'm probably as guilty as everybody else. But yeah, it's not playing out. And I think when you comes back to what Dave was saying, it's the connection they've got with the customer. It's the local being in place and providing that service, that what you're lending for and why you're lending for it. I think for the vanilla stuff, I think what you said is true, right? I think the vanilla processing, being able to do that at cost, get it through, get it done. But that's not what these guys are doing. They're sitting there understanding the customer better and providing them a better product. So the technology itself, as I said to you a minute ago, deposit account is a deposit account is a deposit account. I mean, there's the fact I can run it for 1 pence versus 4 pence doesn't make much of a difference. And whether it's on COBOL mainframe versus not, yes, the operational cost for this stuff is orders of magnitude more, but you're not talking very much as a baseline. So it doesn't move the needle in a way that we would see it in that sense, because they're not doing the volumes that it would show up in.
And I've got to ask you the outright question before Dave jumps in with it, because at the moment, there's a lot of noise, I guess, if you want to put it that way, on the internet saying, oh my gosh, the current version of 4.6 person and the new version of ChatGPT is close to our AGI. You know, don't do anything drastic in the next 2 years. I mean, even Mo Gadwat said, if you're in your 20s, don't have kids until you know how this plays out in the next 2 years. I mean, you're a person I respect because you're closer to the tech. What's your perspective? How different will this financial services and banking and the equity release space be, let's say, in 3 years?
Cheery vision, isn't it?
I wasn't going to say that, actually.
No.
Yeah.
It's a question we have to ask everyone.
No, I totally.
We all have to recognize just 3 weeks ago, there was an AI bubble and everything was going to shit. And now 3 weeks later, all the SaaS companies are doomed. The truth is somewhere in the middle, right? Let's all recognize that before we start. 4.6, open claw, played with it, got it running, having a look. It's fun, dangerous, but fun. 4.6 is great. Really, truly, it's probably the first model I've run some stuff in and thought the code is good enough to put out there into production, honestly. But I still need to spend a lot of time checking it, harrying it, telling it where it's less so about hallucinations now, but just where it's gone off on the wrong idea or got the wrong algorithm, wrong idea about what to do, not written some horrible code that won't work, which the others do, by the way. But I think fundamentally, financial services is going to change massively in the next 5 years. I can't see it. The genie is out of the bottle. The thing works today, but not in terms of what a customer has, because regulation won't move that quickly. We'll all be too sure of ourselves saying, oh yeah, we're going to have personalized buying patterns through consumer demand where we're going to personalize products and all this stuff. I mean, I've been talking about that for about 4 or 5 years, maybe even longer, with the smart contracts and being able to personalize and break up your products into multiple features. I've only ever done it in one bank. It's been very successful, but I've only done it in one bank. Everybody else wants a vanilla credit card, a vanilla mortgage, a vanilla deposit account, because the customers aren't educated and the cost to educate them is way too high to move it through. We're seeing customer demand change. What's the stat? It's like 1,500% increase in AI usage on the internet in just the last 6 months. AI traffic now accounts for 65% of all internet traffic. I mean, then that's customer driven. That's not enterprise driven. That's customer driven, hitting everything. So the last time we saw user model change like that was the Apple iPhone, and then it changed interaction models and other stuff. So we are going to see things change, but I think we're going to see it more in the working structures. And you talked about this in the last couple of weeks, Dharmesh. I mean, I completely agree with you. We're going to get rid of the easy work, whereas today, like 90% of, in some cases, mortgages get referred to an underwriter. Only 10% will get referred. But those 10% will be bloody hard work that they've got to do and get through that. And once we've got these personalized engines and we've got this stuff running, then we can start pushing that up towards through GPT interfaces or whatever else and push that up into customers. And I think the GPTs will start doing the education that we could never manage to do. So we couldn't educate customers well enough in how they could handle this stuff, how they could understand how certain products work versus other products and different features are good for them or bad for them. I think when a GPT knows a ton about you, then it can start doing the education process. And then we become almost transactional again in some respects, probably back down to our singular products or a variation of the personalization of the features. But we could start putting out some really complicated products that the GPTs could start simplifying and selecting for the end user. The problem with that is obviously regulation. How do you prove what that is? How do you explain what has gone through? How are you sure you're looking after the customer and we haven't had an hallucination through the middle of it? You can do that inside when you've got a human in the loop or you've got a human test subject that can run stuff through alongside, and we can do back testing and verification of that stuff. When you start throwing that up into models where you're not in control, you don't have the data, you don't have the input, I think regulation is going to have to work along hard lines to get to that point. I think that's going to be a limitation for the customer-facing stuff. Inside a bank, I think it's going to be everywhere within 2 years.
Interesting. Well, listen, I think we're kind of out of time. I did have one question just to kind of finish on, which is as we move into this sort of future, this AI future, I've been sort of thinking about trust a lot. And I really think kind of community financial services has a huge opportunity. When we talk about equity release, we're sort of talking about sort of towards the end of people's lives. We've got a real problem with people at the start. Yeah. And I guess one of the questions is how do you kind of take that knowledge and start addressing that, but through kind of more community-based banking initiatives, because the young people are really struggling to kind of get on the property market. Do you see opportunities there?
100%. I think there's a blend of two things, though. I think there's a coming together as a unit, and that might be your family, it might be your community, it might be your social net group that you've been to university with. That sort of pooling of capability, capacity, or anything else to enable you to do those things. And the assessment of groups is going to be important. I also come back to that education point of view. I mean, we all know that education of people, whoever are smart and everything else, are not financially literate. And I'm struggling to get my kids to even understand any of it. So, if I can't do it, I'm sure other people are really going to struggle. But I think there's a mixture of both education, getting that into schools so they know what they're getting themselves into beforehand and what is out there. Because I don't think people understand what's out there or how to go about getting it, accessing it. And then how do you group that together? And I think communities coming together to do the education, to enable people to access those things and find the right way to do it. There's got to be something in the middle of those pieces that enables that to happen. We're just not good enough in this industry at educating people about how we cloak it in a whole load of complicated things, or we cloak it in UIs that bank people understand that have you need to know the trick of how to write this into there to do this, to do that. And that's what a GPT would do really well, by the way. It would know what has made it work and therefore can just execute that thing. When a customer says, I really want this, it'll translate it. But there's those sorts of things that they need wider education, but also we need to look at how communities come together to help everybody to get to that point.
I really like that. Again, the opportunity around kind of family finance is, I think, a huge one, which nobody can tackle. So,
yeah, and wider family, right? It's not just people think of the 4 or the whatever atomic unit. If there's a few financial advisors that over the years that actually run their whole thing across the wider financial group with grandparents and other stuff, all collectively pooling together investments and other things with clauses when they run, etc. And it's in a foundation. Going back to IHTs, it starts to move past those sorts of things and do some financial planning in that way. But that's a wider group than people think of as just the family, which is parents supporting kids. I think it's multi-generational and it's probably multi-branch as well of family to bring that together in some way. But we feel a long way away from that. But that's something that people should think of.
Amazing. Well, thank you so much.
You're more than welcome. Thanks, sis.
And I guess it's very heartening to hear that the things like sectors like the building societies are kind of alive and well and running very cool technology.
Yeah, look, there's real challenges out there. Funding costs are not, when you've got Chase and Marcus at 4.5%, when the base rate's at 3.7%. That makes funding quite hard. But, we're there to help them out and drive that forward along with the banks and other financial institutions together. But thanks for your time today, guys.
Well, thank you.
Thank you for tuning in to Dave and Dharm Demystify. We hope you enjoyed the show. Don't forget to like and subscribe and tune in next time as we take another topic and demystify it.